All right, everyone, in today's video, I am going to share my top 15 dividend stocks of all time. These are stocks that pay dividends, that literally pay dividend checks, that investors like myself can use to pay the bills. Anyways, I have already shared my top 10 favorite stocks of all time. I will link in the description below if you want to watch that video. Also, if you've been watching my channel for a while, you've probably downloaded already my complete stock portfolio. If you have not, I will link in the description below so that you can download my entire dividend stock portfolio. Now, if you've been looking at my stock portfolio, you'll see that I classified stocks 1 through 10 in sequential order. But then when it came to 11 through 15, I just lumped them in a bucket. I didn't really order the stocks yet. And so the purpose of today's video is to go through stocks 11 through 15 in specific order. This is the specific order in which I like these dividend stocks. Why am I doing this? I'm doing this because my strategic goal in 2019 is to focus on my core. It is to focus on my top 15 favorite dividend stocks of all time in terms of deploying more money. As I deploy more money this year, I'm trying to really stay centered around my core. Sure, I'm going to have some exceptions, but in general, I am adding to my top 15 favorite stocks. And I'm doing that because I want to prioritize my best ideas, my favorite stocks. And so without further ado, let's jump into my top 15 favorite dividend stocks of all time. So jumping right into it, my first one is a controversial company. I know a lot of people, they tend to get concerned about politics. They tend to follow politics. Sometimes politics even affect their happiness in life. It gets them down or they get excited about it. I don't really play any role in politics. Yeah, I try to stay apprised in general of what's going on, but honestly, I like to focus on money. I try to stay out of the politics. And so when it comes to politics and investing, it really doesn't concern me that much. Anyways, my first pick here, number 11 out of 15, is, as you guessed it, Starbucks. I love Starbucks. This is one of my favorite stocks of all time. It made 11 here for a reason. Honestly, this is one that could have made my top 10 favorite dividend stocks. The reason it didn't is McDonald's comes in at number 3 and I need to diversify. So as I go through these ideas, I don't want McDonald's and Starbucks to be in the top 10 because they're just too close. Anyways, Starbucks comes in at number 11. The reason I like this stock so much is the compound annual growth rate of the dividend is just off the charts. We'll get to that in a minute. Anyways, the current price per share is $69 and change. They pay a dividend of 36 cents per quarter. If I take the quarterly dividend, multiply by 4, divide by the price per share, I get the current starting dividend yield. It's really low. It comes in at 2%, 2.06. This is versus my portfolio average of 3.8. So this is really low starting yield. That being said, it gets compensated by the fact that the dividend is just growing so quickly. In February of 2014, the dividend was at 13 cents per share. It was actually 26 cents per share, but there has been a stock split, a 2-for-1 stock split. So in adjusted basis, it's at 13 cents. The current dividend per share is, as of February 2019, is 36 cents. So it's gone in just 5 years from 13 cents to 36 cents. When I apply the compound annual growth rate formula to this, basically the rate of growth of the dividend per year on average over the last 5 years is 22.6%. This is just astounding. It is a fabulous dividend growth rate. Personally, I think it can continue. I don't know how long it will continue, but I think it will continue. I think they're making a lot of smart moves. If it continues, let's just say hypothetically, it continues for 10 more years. Yield on cost for the shares I'm buying now will come out to 15.8% in just 10 years. And so the way that I get this is I take the current starting yield, I multiply by 1.226, and then I take that to the 10th power. And so it's 2.06% times 1.226 to the 10th power. I get a 15.8% yield on cost 10 years out. And so in other words, what this means is for dollars that I'm deploying now, for money that I'm deploying now, my dividend, it's going to grow over time. It's going to grow incredibly. It's going to compound because the growth rate of the dividend is so high. And then when I take future dividends and I divide by my purchase price now, that's what I'm talking about in yield on cost. And so I love Starbucks for a number of reasons. Obviously, number one comes down to the results, the financial results, the money. Show me the money. That's what it comes down to me. I don't care about the politics. I don't care about this or that chatter in the media. Honestly, I think a lot of it is a distraction. I try to stay away from the distractions. I try to focus on my money. Anyways, the other reason, though, I like Starbucks is it really is a home away from home for me. I look at it as an office. I spend a lot of time there working, literally drinking my cup of coffee, my cup of hot chocolate, grabbing a snack, a croissant. I will sit there and I will work for hours on end. And so it's a really good work environment. I feel a lot of inspiration there. Every time I go there, it's always packed. And so every Starbucks I go to, here at least in California, they are packed, they are busy, people are always there, people enjoy it. It's an affordable luxury. Another way I'll look at it, so I'm going to get to this in a minute, but I talk about sin stocks later. My number 13, by the way, is Altria. In olden times, and I would say even to this day, a lot of people will take a break from work. They'll take a break from work, they'll step outside, they'll enjoy some of the adult products that are sold for adult consumers by companies like Altria. That is a break for people. It is a break from work. Well, the way I look at it is something like Starbucks provides the same luxury. Let's say you're having a busy day at work. Let's say, look, you've got some kids like myself and things can sometimes get busy with the family life. Let's say your weekend was even more busy than your work week. You get to work, you're starting to work, and you're like, you know what? I want to do something for myself. You know what people do these days? Maybe they have a product from Altria and they step outside, take some time for themselves. But what other people do is they get in the car or they walk, they go to Starbucks. They buy a drink, they buy a croissant, they buy some nice beverages, maybe they go alone, maybe they go with friends, they sit down and they take some time for themselves. This is a luxury, it is an escape, it is a simple luxury, it is a break. And that is how I look at Starbucks. I think it is such a defensible industry, such a defensible company. They've locked up the real estate. They still have opportunity to expand internationally. They've got the brand. I don't think they're going to be displaced. They're going to be around. I know a lot of people disagree that there's not a competitive moat with these guys. I would argue there's a very competitive moat. They have one of the most recognized brands in the world. The other thing I would say about these guys is I think they have the #1 payment processing app around. Their app processes more payments than any other app. And so from a technology perspective, they're very defensible as well. So Starbucks, my number 11. I look forward to adding more money to Starbucks. I don't think it's a great value right now, so I'm just waiting. But I did add into my position some more in 2018. If it dips again, I will add more. What I'm looking for these guys in the future is some smart international expansion. And one closing thought from this thug. I like to stay focused on my money. Yes, the politics and the money, they sometimes coincide, but I personally like to stay focused on my money. I try to ignore a lot of the distractions out there so I can leverage my time and invest wisely and make money with dividend stocks. All right, everyone, so stock number 12. This one is going to surprise a lot of people. It is a stock that I've been tracking for years that I first started adding in 2018, and it's Cedar Fair. This is a smaller company. It's an amusement park company that operates in the United States and Canada. They operate amusement parks, and it's traded as a master limited partnership, meaning owners, shareholders, they're actually unit holders. They get distributions from the company, and they get K1s as well, because this company passes through tax consequences to the unit holders. And so there's some complex things that go behind owning Cedar Fair. I will link in the description below to an entire video that I did about it. For me to deal with K1s and to have a company that's an MLP in my portfolio, it has to rank pretty high, because otherwise it's just not worth my time, the hassle of the K1s and the extra accounting and the extra work. And so above and beyond that, though, with Cedar Fair, it's kind of like 3M. 3M, by the way, makers of this awesome Post-it board. They're my number 10 favorite stock of all time. Even though I first started buying them in 2018, they made it into my top 10. They're number 10. Similarly, even though I bought these guys first in 2018, they're my number 12. This is really weird, really strange for someone who has been investing for over 20 years. I had to get over my pride. I had to get over the fact that, you know what, Ian, you're late to these stocks. You should have bought them years ago. I've been watching them for years, never quite went ahead and did it. That being said, I did it. I'm going for it, and I got over my pride. They're making it in to my top 15 with Cedar Fair and my top 10 with 3M. Just had to do it. And so anyways, with Cedar Fair, current price per share is $52.65. The current dividend per share is 92.5 cents per quarter. And so if I take the quarterly dividend, multiply by 4, divide by the price per share, the starting yield is an astounding 7.03%. The reason I like this company so much is it brings starting yield to my portfolio. Let's say I have all my money in StarBucks and I need cash flow tomorrow. StarBucks isn't going to provide me cash flow tomorrow. It's going to provide me cash flow 10 years from now. However, if I need my money tomorrow, Cedar Fair is going to provide me cash flow tomorrow because the starting yield is huge. And so I like to diversify my portfolio with future yielders, with high dividend growth companies like StarBucks, and current yielders, lower dividend growth rate like Cedar Fair. And so that's why Cedar Fair, I think it complements some of these other stocks really nicely. Compound annual growth rate for this thing is, I project it to be really low. The growth rate actually compound annual, if you look at it like last 5 or 10 years, it's actually quite high. That's because the dividend, the distributions, they were actually lowered during the Great Recession. Again, I talk about this a bit in some of my prior Cedar Fair videos, ticker symbol FUN, that I'll link in the description below. But anyways, I think that misrepresents what the compound annual growth rate will be going forward. So going forward, I use their investor deck, I look at their investor presentations, what will the dividend growth rate be going forward, and they target basically 3 or 4%. So I just projected at 3%. Basically, I don't expect huge dividend growth from this company, but I expect a high starting yield that will reward me as a unit holder. So I like Cedar Fair for a number of reasons. It helps me diversify. It is an amusement park company. It's a lot different than my bread and butter consumer brands, consumer non-cyclical companies. I like this company because it's, again, like Starbucks, an affordable luxury. It's a lot cheaper to go to an amusement park than to hop on an airplane and go to Europe for the summer. And so it's a lot easier to go to an amusement park for a few days than to take your family to Hawaii. These types of companies like Starbucks and Cedar Fair that provide these simple luxuries that offer consumers an escape from everyday life for a reasonable amount of money, in my opinion, are awesome stocks. They're really defensible. They can weather economic cycles up and down. I like it because these guys are a small cap. I don't have a lot of small caps in my top 15. This is probably the smallest company I have in my top 15, so I like that. I like the current yield. I want to talk about depreciation and MLP here. So a lot of folks ask me, Ian, why do you buy this company? When I go online, their earnings per share are lower than the dividends. How can they pay their dividend? How is it possible? I would like to invite you, again, I'll link in the description below, to check out my review of Cedar Fair. In fact, that review has a spreadsheet that you can download and it'll help accompany the video. And the spreadsheet has my complete model, my complete analysis in it. And I basically back into cash flow that can be used to pay dividends. And the cash flow covers the dividends. The reason that the earnings per share looks wacky is earnings per share is on a GAAP basis. And on a GAAP basis, there's this concept of amortization and depreciation, and they get canceled out. Basically, GAAP earnings are post-depreciation. But the thing is, with Cedar Fair, there's a huge amount of depreciation, massive amount of depreciation, because they buy these attractions at their amusement parks, and they depreciate them on the books really quickly. And so basically, the GAAP earnings for this company, they can be totally thrown off, whereas cash flow, I think, is a much better proxy of their ability to pay their distributions. And so that's why EPS looks weird. It's because of depreciation. It's because, quite frankly, they are a real estate company. They own a lot of real estate, and on their real estate, there are improvements. And the improvements that have been made are hotels, restaurants, amusement park attractions, roller coasters, and all this stuff gets depreciated. that depreciation totally throws off the GAAP earnings, and because of that, GAAP earnings look lower than the real number that is being used to pay the distributions. And so that is the secret behind Cedar Fair. But again, the key point here, also Cedar Fair worth mentioning, is I like to buy it in bigger tranches, so I buy more of it at once just to keep my accounting simple. This is not the kind of thing I like to buy monthly, I like to average into. I'm not even reinvesting my distributions on this. I'm pooling distributions and I'm buying in lumps. The reason I'm buying in lumps here is to keep my accounting really clean, because when it comes time for taxes and K1s, I want to have the best possible records because it can get a little complex. And cost basis calculations, etc., are really important for something like this. Make sure to talk to your accountant, your tax advisor about MLPs before considering MLPs. Lots going on there, so I like to keep my buy orders simple to keep my records simple. Anyways, that's Cedar Fair number 12. I'd love to hear what you think. Are you guys shocked about that? I know you probably could have guessed Starbucks, but Cedar Fair, newcomer to my portfolio. I kind of surprised myself here, but it totally makes sense. So moving on, number 13, hinted on this before, Altria. I'm going to link in the description below. I invest in SIN stocks. I own all of the SIN stocks. I will link in the description below. I did an entire video on my SIN stock portfolio. Quite frankly, SIN stocks represent too large of a percentage of my portfolio. That being said, I've been adding to some of them in 2019. Because there have been bargains. One of the bargains that I've added to this year is Altria. And Altria, the reason it's my number 13 is I am personally yielding 20% on cost. On the shares that I bought back in January of 2009, if you take my cost basis on those shares, you take the current dividend per share, you divide the current dividend per share divided by my cost basis, I am yielding 20% on cost. It's the first stock that I own that is actually doing this. Other than another one, Reynolds American, that got acquired and taken out. That would have been another one that was neck to neck with this guy in terms of yield on cost. But anyways, this one is freestanding. It continues to operate as a company that has not been acquired by someone else, and I'm yielding 20% on cost. So for that alone, it's one of my favorite companies. It's actually probably been my best performer in my portfolio. The current price per share, $49.66. Current dividend per share, 80 cents. Current yield, starting yield, I take the dividend, multiply by 4, divide by the share price, 6.44%. So this is a reasonably good starting yield. It actually was up there closer to 7% earlier this year. Great starting yield, reason to like it. But in addition to having a good starting yield, compound annual growth rate is really high. Compound annual growth rate for this thing has been 10.8%. So on average, they've raised the dividend 10.8% per year over the last 5 years. If that continues, this could happen again. History could repeat itself. For the shares I'm buying now in 2019, 10 years out or so, I could be, again, history could repeat itself. I could have a phenomenal yield on cost up there in the 15 to 20% range. We will see, but I don't know if it'll be that high, but I think history certainly is repeating itself here a bit, where the stock is on sale, dividend growth rate is high, kind of has the best of both worlds. I'll link in the video in the description below. I did a whole video on this, how I think this stock is the best of both worlds. It has a fast dividend growth rate and a high starting yield. Very, very rare. Anyways, it does not come without risks. It is a SIN stock. It participates in an industry that is on decline. Quite frankly, a lot of the people that were purchasing Altria products to take a break from their day, maybe they're now just going to Starbucks. You know, maybe they've cut back. Maybe they're not using Altria's products as much. I'll tell you where Altria is being really smart is with their acquisitions. I think they are paying very aggressively for their acquisitions, but I think they are smart at the same point because they are proving that there will be a future for this company. I think a lot of people are concerned because these products that they sell, they've been on a decline over time. These products have been on a decline, though, for decades. And so, for decades and decades and decades. And even so, they're still doing just fine, and they're growing the dividend really quickly, and they're doing all right as a company. That being said, is there a certain inflection point where they can't raise prices anymore, where the declines in volume catch up with them? We shall see. And that's why it's number 13, and it's not number 1. It's not in the top 10. It's in the top 15. And I'm actively trying to scale these companies back in my portfolio from a risk mitigation standpoint. And that's why this is 13 and none of the others are in my top 13. That being said, I just can't ignore this because many studies actually show that Altria is the best performing company in the stock market's history. A lot of people think, is it a tech stock? Is it one of these .coms? Is it something else? No, it is actually Altria. This is a company that's created huge value for shareholders. You may not know this, but Altria actually has a stake in Miller Brewing Company, which was acquired by Anheuser-Busch. They still have a stake in that. This was actually the company behind Kraft and Mondelez, which were spin-offs from it a number of years ago. And so value created through the management team of this company has been staggering. It has been staggering, and for that reason, it is my number 13 stock. It has been one of the best performing stocks of all time. Now, from a socially conscious standpoint, because I know I'll get comments about that, I cover that in my Sin Stock guide. So check that out. I did a whole video on it. I have a guide that you can download. You can learn about my philosophy. But in general, I believe in the free market. I believe in the consumer's discretion to appropriately determine which products make sense, which products don't make sense in their lifestyle. So I like to give power to the consumers, to the people making their purchasing decisions. I tend to believe in less regulation. I tend to believe in smaller government. I tend to believe that consumers ought to know what is best for themselves and to exercise smart moderation, just like they would if they were going to Starbucks or to McDonald's, my number 3 stock of all time. If someone had gone to McDonald's for 3 meals a day every day, that's probably not the wisest decision that someone could make for their life. And so again, I love McDonald's. It's my number 3 stock of all time, and I place a lot of value on the consumer making the right choices, the appropriate choices for their personal lifestyle, for their family, and for their health. Moving on, number 14. You guys, you've probably been waiting for this one because I have been talking about this stock forever. I am talking about Kimberly-Clark, makers of the Huggies brand of diapers. What I have here are the pull-ups. I have been talking about Kimberly-Clark here on my YouTube channel forever, so they've just got to make it into my top 15, and they are coming in at number 14. Procter & Gamble is my number 8 favorite stock of all time. I was debating, do I want Procter & Gamble? Do I want Kimberly-Clark in the top 10? Procter & Gamble made it, so Kimberly-Clark's coming in at number 14. I like Kimberly-Clark because it is a stable company, it's a stable brand. We go through a lot of diapers in this household. I have 2 young kids, and their products, look, any market anyone is in, your kids need diapers. I don't care if the economy is good. I don't care if the economy is bad. I don't care if it's a record earnings year for your family or income is a little tight. Everyone needs diapers who has kids, and they make a ton of other products too. Cold and flu season, everyone needs Kleenex. And so I love Kimberly-Clark, Procter & Gamble too for that reason. But Kimberly-Clark, I'll tell you, it's not a get-rich-quick stock. It's a really steady Eddie. It's a stable company. It's not going anywhere, but it's not creating massive wealth at this point either. Something like Starbucks, in my opinion, could generate massive wealth. Something like Cedar Fair, maybe not massive wealth, but boy, is that a nice starting yield. Altria could create massive wealth, and quite frankly, I've experienced this in my investing career when in my early days I was nearly 100% in sin stocks, and I'm now yielding 20% on cost. Kimberly-Clark is just not going to do it. I'll show you why. $116 price per share, $1.03 dividend. Take the dividend, multiply by 4, divide by the price per share. Current yield is 3.55%. Really low yield, and the compound annual growth rate has been only 4%. Going into the future, the yield on cost isn't going to be huge on this thing. I only like to buy Kimberly-Clark when the starting yield is closer to 4% because that's more of a value. This isn't a quick dividend growth stock, but what it is it's a defensible company. It provides diversification. It's not going anywhere. It's kind of an anchor to the portfolio, and it has products that I stand by, products that I love, products that benefit families all over the world. So Kimberly-Clark, I've talked about them at length. That's why they're my number 14. I see probably a higher growth profile for Procter & Gamble than I do for Kimberly-Clark, although I like both brands. You guys know if you've been watching my channel forever, it's all about consumer non-cyclical for me. But I'll tell you, as you go through this and you look at my stocks, you'll see each company has a different profile. Yeah, not every company has to be the high growth one. There is a place, a time and a place for something like a Kimberly-Clark that has the slower dividend growth rate, not a huge starting yield, but boy is that ship solid. It's going to go through anything. It's a tanker. There's going to be no problems with it, in my personal opinion at least. And so there's a time and place for all different types of companies because there's synergies between them all in the portfolio, and that's the place that Kimberly-Clark plays. So next company that I want to talk about is one I used to talk about a lot on this channel. I was debating, should this one be in my top 10 or should Duke Energy? Duke Energy made my top 10. So Southern Company, rounds out my 15, this top 15, number 15. This is a publicly traded utility company, a regulated electric utility. Starting yield on this thing is a 4.86%. I like to buy Southern when the starting yield is closer to 5 or even higher than 5. Compound annual growth rate is only 3.4%. So the dividend's not growing very quickly, but what is happening on this stock, which is great, is it gives a strong starting yield, kind of like a Cedar Fair, but not quite as strong as Cedar Fair, gives some good current income. Current plans are to retire in the future, so I've got time. That said, life can throw curveballs, things can come up. What if I want to start paying some of my bills with dividends tomorrow? It is companies like Cedar Fair and Southern that are going to help me do that, because I buy it today, I start getting massive dividends tomorrow. I love those high yielders. And I've always liked regulated electric utilities because they're basically monopolies. There's not someone going to come in and disrupt them, because these are companies that are regulated by local governments to provide electricity to customers. And so it's not like a disruptor is going to come in and take Southern out of business, because they are the electric utility and they are regulated by the government. And so there's this synergy between them. They're kind of quasi-government type of agency, type of company. It's just a steady Eddie thing. Now, I think the biggest risk to a utility, and the reason I have 2 utilities in my top 15, is we all know what just happened with Pacific Gas and Electric Company. If something happens with one of these utilities, they actually carry quite a bit of risk, more risk, I think, than a lot of investors think. A lot of investors think, hey, utilities, they're the best stocks for widows and orphans, basically people that can't afford to lose 1 penny. They're the safest companies. At least that's how they've always been marketed. I don't think that's the case. I actually think they carry as much risk as anything else. I think something like a Kimberly-Clark has considerably less risk than something like a Southern. That said, I get past the risk by diversification and picking companies that have had solid track records like Southern and Duke, which are both publicly traded utilities that have done quite well. So that is my top 15 dividend stocks of all time. If you want to see 1 through 10, by the way, I'll link in the description below again to that video. Check it out. But this is 11 through 15. Now you know the precise order. What am I buying now? What would I like to buy this year? I'll tell you, what I'm buying now this year for sure is Cedar Fair and Altria. Which ones would I like to add more to if opportunities arise? SBUX and Southern. I feel pretty good on Kimberly-Clark. I got enough money in it at this point. So, and I've got enough money in consumer, non-cyclical, consumer staples, brand name type companies as it is. And so the one I would hope the most for a buying opportunity, quite frankly, would be SBUX. But the one that I like the most right now is Cedar Fair, followed by Altria, just because I already have too much exposure to sin stocks. Which stocks are you buying in 2019? Please share in the comments below with the community. We have a thriving community here on YouTube. I'm so proud of this community. I love you guys. Thank you for all the support. Likes, comments, subscriptions means the world to me. If you want to thank me for these videos, the best thing you can do today, hit the subscribe button, turn on the notifications. That is the best way to support this channel. Before I leave today, in terms of a friendly disclosure, full disclosure, the stocks that I mentioned today, I own in my personal stock portfolio. I am long. I own 3M, ticker symbol MMM, SBUX, ticker symbol SBUX, McDonald's, ticker symbol MCD. I own Cedar Fair, ticker symbol FUN. I own Altria, ticker symbol MO. I own Kimberly-Clark, ticker symbol KMB. I own Southern Company, ticker symbol SO, and I also own Duke Energy, ticker symbol DUK. I own all of those companies mentioned in today's video in my personal stock portfolio. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my personal journey here on YouTube for fun and entertainment value. Everyone, thank you so much for being here. I love you guys. I will see you in the next one, next dividend investing video.